wanted to talk to you today about the Trump bump, or the Trump rally, whatever you would like to call it. As you know, we don't waste any of our time trying to forecast the markets, and that's because we don't believe, and the evidence has shown, that no one can accurately predict the markets over any significant period of time. Our investment philosophy proved its value once again on the night of the election. Leading up to the election, all of the pundits, the talking heads, and the polling operations were absolutely convinced that Hillary Clinton would be the next president. In the markets, all the analysts were on board as well and predicted that if somehow Donald Trump were to win, the markets would take a big fall because the markets don't like surprises, and a Trump win certainly would have been a big surprise. And just like the pundits predicted, in the middle of the night when the results were being counted and it looked like Trump might win, the futures markets, which are a measure of how our markets will trade the next day, were showing a deep drop in stock markets around the world. But by the next morning, the futures had recovered a bit, and by the end of the day, we actually had a nice rally in the markets, proving once again that trying to predict is futile. Since the election, the markets have rallied very strongly. On election day, the Dow was sitting at just under 18,000. As I put this video together, the Dow was just under 21,000. That's a big run up. The first question that comes to mind for most investors is why? With all the craziness that surrounded the election and everything that's happened since then, why is the market rallying so strongly? Now, I'm not an analyst, but here's my best explanation. President Trump is seen as a pro-business president. One of the main things he campaigned on was his pledge for tax cuts for both us as individuals and for businesses. If our individual taxes go down, we'll have more money to spend on vacations, dinners, and other things, which means more revenue and profits for the businesses that we patronize. If those same businesses have their corporate tax rates lowered, it'll add even more to their bottom line, and more profits for businesses usually means higher stock prices, and that's what I think we're seeing right now. So, what has the recent run-up meant for your portfolio? Well, obviously, the stock part of the portfolio has done very well. The bonds in your portfolio have been flat to slightly lower because of the slight increase that we've seen in interest rates. So that means when we run a rebalance, we'll be selling a bit of the stock holdings that have had such a good run-up and buying some bonds which have fallen below the weight that they're supposed to have in your portfolio, and that's how we keep your portfolio in balance. But we also have to be prepared for the inevitable pullback in stocks. This upward trend that we've seen recently can't go on forever. We have to have a pullback, and I would expect it in the not too distant future, but we just can never expect or predict when it will happen, and we're never happy when it does happen, but it's actually healthy for the markets to correct any big moves that it's made in either direction. So, in this upside down world that we're living in right now, let's enjoy the gains that we've seen, but let's also make sure to stay prepared for the pullback that will hit us when we least expect it. If I were a betting person, I would say that it might come right after one of President Trump's infamous tweets. But we don't know, so we'll just hang in there. And of course, if you have any questions, don't hesitate to give us a call. Thanks for watching.